In this video, I'm going to talk about Glaxosmithkline, or more commonly known as GSK, and give my views on whether you should buy this stock right now. Don't forget to leave your suggestions in the comment section down below and drop one of these to support the channel. All research is in the bottom of the description in the sources down below. Pretty sure next week I will be covering Cineworld. Glaxosmithkline is a pharmaceutical company with 99,400 employees and a market capitalization of £72 billion, making it the second largest listed company on the FTSE 100, only trailing behind AstraZeneca. GSK is a research-based pharmaceutical company which creates, discovers, markets, develops and manufactures pharmaceutical products. They only produce branded products that they themselves have created that go into the human health market. Since we are in the middle of a pandemic, it is interesting to look at healthcare stocks, as I would imagine a lot of investors would have priced them up heavily, which makes them less of a potential value opportunity. Although, is this the case with GSK? When looking at a price to earnings ratio, GSK could be considered as undervalued. This is because they have a lower price to earnings ratio than both their industry and also the market. But it also tells me that investor sentiment is lower, and therefore the investors of this stock are not so confident that this stock will outperform the market that they are in, which does mean a significant thing. GlaxoSmithKline takes up 5% of the FTSE 100. Therefore, if they are to underperform their own market, yet have such a high weighting towards it, it doesn't bode well in my mind. However, this is actually disputed by their price to book ratio, which is 5.3 times, which is considerably higher than the market and the industry. This suggests to me that investors suspect that these assets are either going to depreciate with time, or that this business simply just doesn't hold many assets and it could be more of a bad metric to look at. Furthermore, if we look at the price to earnings growth rate, we can infer that analyst forecasts are not too confident. This is because they are trading at a very high price to earnings growth rate. Usually you'd like to look for ones with less than 1. I'm not so confident on analyst projections, but it still doesn't bode too well, and historically they've not had the best earnings growth either. However, I do believe there is a bug with the software, typically internet software. They don't know how to discount between the selling of an asset and legitimate earnings. And therefore in 2015, the earnings for GSK were considerably higher, giving them a profit margin of something like 44%, which does say that over this 5-year period that they have had on average a return of -2% on their earnings. However, if we look a year later in 2016, they had profit margins of 1%, and now in 2020 they have profit margins of 19%. Revenue had been growing but has remained a little bit stagnant, but it could still show there is signs for growth. And so the best way for me to look at this is to not only look at the quality of the management, but how well placed the business is for generating returns. I like to look at how well a business can generate returns on shareholder equity, as it gives me a good insight into the management and the company. Currently, GSK do have a fairly impressive return on equity, which is 36.5%, which is well more than double their industry, and I would consider this to be an excellent score. This is because I believe that companies that get a better return on shareholder equity of 30% are very well placed. Although there is an issue with this metric, I'm going to discuss this in a minute. Furthermore, if we look at the returns on capital employed, which is how well the business is able to reinvest their spare capital or cash, we can see that they have generated a return of 14.4%, which isn't too bad. It's not great. I would consider that 20% threshold to really push them into a great stock that really stands out from the market. But when we look at how it was 3 years ago, it is on a decreasing trend, which suggests to me that either the business isn't doing as well as of late, or perhaps it's been affected by the pandemic. Regardless, these metrics can be skewed by high debt loads, hence why we may see an overinflated returns on shareholder equity. Well, honestly, the quality of GlaxoSmith's balance sheet isn't that great, and I would consider it to be fairly poor. This is because their short-term assets slightly underweigh their short-term liabilities and also their long-term liabilities. This is combined with a significantly high debt load of 151% of debt to equity ratio. Not really a business that ticks my box on the quality of the balance sheet. However, this is redeemable by their operating cash flow. They are a very cash generative business, and therefore if they wanted to, they could clear this debt in 3.14 years if they put all of their free cash flow into their debt. This is also backed up by their very strong cash position of £8 billion, although this is to be considered that their debt is touching around 30 billion. So yes, it is a strong cash position, but this also may be needed in future. So if they've got a great cash position but a lot of debt, does this impact their ability to pay a dividend? Well, in fact, actually GSK is well known as an excellent income stock. This is because it's currently yielding 5.52% and pays quarterly, which in the UK is very rare. This means that you'll be getting payments in January, April, July and October every single year, which allows for your portfolio to compound with dividend payments. Combined with a more on the higher side payout ratio of 59%, this could suggest that there is room to grow the dividend in future. However, there is a crucial issue with this stock that I do not like, and that's because whilst in the last 20 years they have paid a consistent, reliable dividend income, in the last 5 years they've not grown it one bit. Furthermore, if we look at the 10-year compound annual growth rate of their dividend, it is only 2.42%. And if we look at the yield over a 10-year period, it has remained relatively stagnant. This suggests to me that whilst yes, this stock is paying a very strong dividend, it does mean that it also has been fairly stagnant with share price. In my personal opinion, I would consider this to be a deal breaker. However, this is quite a good thing for some people. If you're someone in retirement or nearing retirement and you're looking for income to live off of, then GSK could be a perfect option for you. This is because they're 1, high yielding, 2, a quarterly dividend payer, and 3, a reliable dividend payer, that at least if they're not growing their dividend, they have paid it. And whilst yes, you may say they haven't had too much capital growth, you need to really respect the fact that in this 10-year period, even though they've not grown it for the last 5 years, that it has still beaten inflation, suggesting to me that if you're a person in retirement or nearing it that's really looking for an investment that keeps your overall assets above the level of inflation and also pays you a very strong dividend income, then GSK could be for you. If you'd have bought GSK in the last 5 years, you would have gotten returns with dividends reinvested of 46%, which beats the market of 17.3%. But before you click off, there's actually more to this, and this could be a significant opportunity for shareholders or those interested in this stock. And it's an important event that is coming up. You may think, oh, is it just an AGM? Is it earnings perhaps? Well, no, it's even more important than that. And GSK had actually partnered with Pfizer, and they are going to be splitting their company into 2 parts. Rather than being one large pharmaceutical company, they're going to split into one heavily focused into R&D based pharmaceuticals and one giant consumer healthcare company. This allows them to scale back their operations, perhaps increase their profitability and align the management's focus on their core business models. Potentially, this event could not only mean that for the next 2 years you've got a strong, reliable dividend income, but also after that you may have a growth opportunity. This is combined with the share price being at what I would consider to be a very attractive valuation. And since it is so difficult to calculate an accurate intrinsic value of a company, I do believe that investors, whilst yes, it is somewhat priced in, I do not believe this is priced into an accurate amount. This is because I believe that once they split, perhaps there's more value in these split companies, and therefore standalone they are worth more than the giant itself currently. And therefore this is an opportunity that could be present. However, I'm on the fence about this one, and yes, I do like it as a stock and I would consider purchasing it. However, my issue is that currently GSK is one large pharmaceutical company, and because it is so big, it leads to a lot of complexity. This means that despite doing a lot of additional research, this could still mean that I lack understanding of the business and its model. And therefore, since I could not understand this business, or since I may not understand this business, I'm not so keen on investing into it, simply because if the stock drops further, I wouldn't have enough confidence or conviction in myself to know whether to buy more or sell. And therefore, despite the attractive valuation, I'm not buying GSK. However, as I said, if you are someone in retirement needing that dividend income, then this could be a perfect opportunity for you. Or even for one of those investors that needs a stock that gives them reliable dividend income, but also some fair amount of safety. If you're interested in my stock analysis on International Airlines Group, or IAG, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great weekend.